Greetings, everybody. Welcome to Liberty Call. Today is Thursday, August 3rd, 2023. Hope everybody's having a fantastic day out there. Pretty good day here in Colorado. Lots of sun, not too hot today. Let's see, it's up to a balmy 79 degrees here. So if you're down in Houston or in Texas, I apologize. We did have some hot weather for a couple weeks, but it has finally cooled off. And I think the high on Sunday is like 65 degrees. So anyone who wants to come for a visit, let me know. We got extra beds. Anyways, all right. If it's your first time watching Liberty Call, thank you very much for being here. If you would, please give me some thumbs up, like, share, subscribe, follows, notifications. And let's go ahead and jump into the markets for today. Kind of another meh day in the markets. Nothing, not up too high, not down too low. I mean, it was most of the day, the major indexes were trading in the red. They did get into positive territory for a little bit midday, but lost the steam. I guess those people buying the dip or not enough to prop up the market. All right, the Dow Jones finished the day off down 0.19%, 66 points, closed at 35,215. S&P 500 was down 0.3%, closed at 4,500 even. NASDAQ down 0.1%, closed at 13,959. The VIX was down today, down 0.56%. It's currently holding at 16. Canada was down 0.48. Brazil was down 0.21. And Mexico, lone bright spot, the Americas, up 0.31%. Over in Europe, Germany was down 0.79. The UK was down 0.43. France was down 0.72%. Netherlands down 0.64. Spain down 0.23%. Italy down 0.94%. Portugal down 1.12%. And that's Switzerland down 1.12%. And Portugal up 0.18%. Russian exchanges both in the green today. MOEX up 1.33 and RTSI up 0.62. And the overnights, starting out with the Nikkei in Japan, it was down 1.61%. Australia down 0.58%. New Zealand down 0.52%. In China, the Shanghai was up 0.58%. Shenzhen Component up 0.53. China A50 up 0.89. DJ Shanghai up 0.7%. Hang Seng down 0.67 and Taiwan weighted down 1.85% for the day. So like I said, I think folks are just kind of waiting to see where the markets are going to head. I mean, I have a pretty decent idea, but again, I can really only go off the charts. All right, let's jump over to the market recap. S&P 500 off session lows on dip buying and chips ahead of Apple, Amazon earnings. All righty, where are we? Oops, get to my notes here. The S&P 500 managed to recover some of its earlier losses on Thursday, driven by investor interest in buying the dip in the tech sector ahead of the anticipated quarterly reports from tech giants Amazon and Apple after the markets close. Tech stocks rebounded from earlier declines, especially in chip makers like AMD and NVIDIA, which managed to offset losses incurred by Qualcomm. Qualcomm faced a significant drop of over 10% due to disappointing guidance for the current quarter and third quarter revenue falling below Wall Street, probably second quarter earnings falling below Wall Street estimates. Investors were particularly concerned about management's commentary. Gosh, that's distracting. Management's comment. Where was I? Where'd it go? Investors were particularly concerned about the management's commentary on challenges in the near future, leading Deutsche Bank to downgrade the stock. Moderna, a key player in the COVID-19 vaccine market, reported quarterly results that surpassed fears of larger losses, leading to a minor increase in its shares. However, doubts regarding the sustainability of COVID vaccine sales in a post-pandemic world limited the stock's gains. I can't imagine anyone's actually putting that crap in their bodies anymore at this point. On the other hand, PayPal reported better than expected quarterly results, but the stock fell 8% due to concerns about future guidance and doubts about the company's ability to improve margins. As investors awaited quarterly earnings reports from Apple and Amazon, trading was cautious. Apple's shares traded below the flat line with concerns about the iPhone sales may have slowed due to a weaker smartphone market. Amazon's stock, however, experienced slight gains as investors eagerly awaited the company's update on the growth of its cloud business. Amazon Web Services, despite expectations of a slower growth rate for the upcoming quarter compared to the previous one. Meanwhile, the 10-year Treasury yield surged to 4.17%, the highest level since November. Strong labor market data and easing wage inflation contributed to this climb. Notably, U.S. worker productivity rebounded significantly in the second quarter, while labor costs moderated, adding to the optimism that recent inflationary pressures might continue to ease. Data revealing lower than expected weekly jobless claims for the week ending July 29th also supported the notion of a resilient labor market. As investors digested the data, they anticipated the monthly jobs report scheduled for the next day. Despite the positive indicators, Morgan Stanley predicted a continued softening in the labor market, forecasting a gain of 190,000 jump in payroll for July. This would significantly signify a second consecutive month of declining job growth. All right. Well, is what it is. Let's dive a little deeper into the labor market. U.S. labor market resilient. Productivity rebounds in the second quarter. All right. The latest data from the Labor Department reveals a mixed picture of the labor market. While the number of Americans filing new claims for unemployment benefits rose slightly, layoffs reached an 11-month low in July, underscoring the tight conditions of the labor market. Despite undergoing 525 basis points in interest rate hikes by the Federal Reserve since March of 22. Why just say 5.25%? I mean, you don't have to say basis points. The labor market remains robust with the expectations of strong employment gains for July. This comes as a sign of optimism for the economy and lessens concerns about a potential recession. Inflation is also showing signs of improvement, further boosting the positive economic outlook. Layoffs have significantly dropped, hitting an 11-month low in July. However, claims for unemployment benefits increased by 6,000 to a seasonally adjusted 227,000 for the week ending July 29th. This figure is within the range of 194,000 to 265,000 claims, a pattern partly attributed to challenges in adjusting for seasonal fluctuations. Despite the minor uptick in claims, the overall labor market remains strong, with employers continuing to retain workers due to labor shortages experienced during the COVID-19 pandemic. Data from the Labor Department also highlighted a substantial slowdown in labor costs during the second quarter, mainly attributed to a notable rebound in worker productivity. This trend, combined with reports of reduced inflation and wage growth, sparks optimism that the U.S. economy could avoid a recession. I'll believe it when I see it. Many economists believe that the Federal Reserve is unlikely to raise rates again in this cycle, further supporting the positive outlook. I would say that Chairman Powell has been very blunt that they plan on raising it one more time, probably at the September meeting on the 19th and 20th. If they don't do it then, I would imagine they'll probably do it on the October 31st, November 1st meeting. Let's see here. Where was I? Productivity, a measure of hourly output per worker, increased at a 3.7% annualized rate in the second quarter, marking a significant improvement from the previous quarter's 1.2% decline. The trend in improving productivity, along with a decrease in nominal wage growth, signals a positive decline in inflationary pressure stemming from the labor market. While productivity has historically shown a rate of 2.1%, in the current rate of 1.4% since the fourth quarter of 2019 suggests room for further growth. In conclusion, the labor market appears resilient despite challenges posed by interest rate hikes and other economic factors. The recent data points to a strong employment outlook, easing inflation concerns, increasing productivity, which collectively contribute to the optimism surrounding the economy and its potential to avoid a recession. Again, you can say it as many times as you want, but I don't think you're going to wish it into existence. Again, could be completely off base, but all my forward-looking data points seem to show that things aren't real good in the future. I'll just leave it at that. Last up comes from Zero Hedge. It's titled, "What Do Federal Tax Receipts and Total Receipts Suggest About Recession?" This is written by Mike Shedlock via mishtalk.com. All right, let's see what he has to say. Recent federal tax receipts suggest that gross domestic income numbers, rather than gross domestic product numbers, might be a more accurate indicators of the economy's health, potentially hinting at an impending recession. Tax receipts, as provided by the Bureau of Economic Analysis, the BEA, have shown a decline over the past few quarters, with both total receipts and tax receipts falling for consecutive periods. Historically, a simultaneous drop in tax and total receipts has often correlated with an economic recession. While there have been instances of false signals in the past, this data aligns with income data, further supporting the notion that a potential economic downturn could be on the horizon. This interpretation gains traction when considering other economic indicators. The recent estimate for real GDP growth for the second quarter of 2023 exceeded expectations, standing at 2.4%. Pending until next month when the next set of numbers come out. However, this growth was not entirely corroborated by gross domestic income, which indicated negative growth for 2 consecutive quarters. This discrepancy between GDP and GDI numbers suggests that the current positive economic outlook may not be as solid as initially believed. Furthermore, disparities between non-farm payrolls, account of jobs, and employment levels, a measure of whether individuals are employed regardless of the number of jobs they hold, also raises questions about the accuracy of reported employment data. While mainstream media often highlights strong jobs reports, the consistency between payroll tax data, income data, and household survey, which records employment levels, implies more synchronized and potentially more accurate representation of the economy compared to GDP figures. In essence, these observations imply that GDI might be a more reliable indicator of economic conditions than GDP. While GDP has traditionally been the primary metric used to gauge economic health, the alignment of tax receipts, income data, and employment levels suggests that GDI could offer a clearer perspective, especially when these indicators don't fully support the positive narrative of economic growth. As economists and analysts continue to scrutinize economic data, the relationship between these various indicators could provide valuable insights into the true state of the economy and its potential trajectory. All right, and actually there's some charts here. So this one, see if you bring it up here, you can see that the both of these, total receipts is the blue line and tax receipts is the slower red line. They both turned negative here of late. Same thing back in, what was that, 2008 and 9. And same thing back here in 2000, 2001 with the dot-com bust. So not looking real good. And also with that slight recession we had back in 2020, that was papered over with a lot of money printing. So we're pretty much going to go back through that same process again. All right. Alrighty. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.